the Canadian Finance Guy. Today we'll be doing a deep dive into one of the companies I hold in my portfolio, specifically Lowe's. Let's have a look at the company in a quick video and see who they are. All right, so now that we've seen that video, kind of give us a brief overview of Lowe's. Let's go to their website and let's see, do a deeper dive into who they are. Lowe's is actually part of a duopoly that has the largest market share of the United States home renovation, home improvement, and home building sectors. Lowe's operates out of large warehouse chains, in various cities across the United States and sells its products to both retail consumers and home builders. So as we can see, over 300,000 staff in the United States and Canada. They're not in Canada. Well, technically they are still in Canada, but they just sold off their Canadian business, which we'll talk a little bit more about later. 19 million customer transactions per week. They made $96 billion in sales in 2021, and they do some community service, which they've invested $100 million into. So if we scroll down, we can go to what they do. So like they said, they did 19 million customer transactions in the US and Canada. They operate 2,200 home improvement hardware stores and employ approximately 300 people. So they focus on the customer. They believe in good relationships. They think good relationships are key to success for both the customer and themselves, focusing on do-it-yourself customers and professional contractors. We'll see later, but these do-it-yourself customers are most of their business, currently 75%. 25% are the professional contractors, but they're putting a large focus onto building relationships with these professional contractors, as this business segment is a little lower for them. Then they want to gain some market share and hopefully get some repeat customers. They have a bunch of different products at, at different prices, and they give you some details here, about their in-store 1,700 plus stores in the US, 450 in Canada. This has now changed. They've sold this off to a private equity firm, and we're going to look at that a little bit later. But they sold it off, so they're getting rid of their Canada. It only represents about 6% of their total business, so not a huge or material impact there. Okay, so now that we've seen, kind of an overview on Lowe's, maybe let's go to one of their investor presentations. So this was last year, but still still relevant. Let's go down. So here, last year they were talking about strong home appreciation prices. Mortgage rates were super low, not the total opposite now. But they're still a healthy consumer. And houses are still aging, which we'll hear about later. So Lowe's focuses a lot on renovations. Renovations is kind of their bread and butter, selling those products. So as houses age, people are keeping the same house, but they're just renovating it. which means they need to stop by Lowe's to get specific supplies to help with that renovation. The impacts of COVID had wear and tear due to remote work. A lot more people were inside their house, more people using their homes, and therefore, had to repair certain things, or maybe just, improve certain things that they've been looking at for a long time that they never got around to. Okay, let's scroll down. So here we can see, they're focused a lot, like I said, on getting part of that pro business. So these are professional contractors. This is part of their strategy. They want to break into that professional contract, segment of consumers, because professional contractors, they represent a large business. Home builders, they're buying a bunch of materials at one time. And if they become repeat customers that have established relationships, that kind of almost guarantees a loyalty to Lowe's. Maybe not guarantees, but helps provide, a future predictable revenue stream with those long lasting relationships. They're very focused on growing their online business, as we saw in the video. They now have a tech hub. They're expanding their installation services. And then they're trying to stay their localization and trying to become very unified in that sense. If you scroll down, we can see they're more stressed on being committed to the pro. There's lots of quantities of supplies. They have a good customer relationship management tool, and they've made a pro zone for those pro customers to shop. Give you some more details on the brands. We've seen these brands. Even if you're not into home improvement, like I said, I'm an accountant. I know very little about home improvement, and all of these things. I hire somebody to do this. I hire a pro. But I know companies like DeWalt or Bosch or Eaton. I've seen these companies. So like I said, they're very focused on long term pro growth. Year to date in 2021, they were up 24% in that category of sales. So, and they predict to grow at 2 times that market rate for the next 3 years. Here we can see some more details on their, home, their brand penetration. So the brands are bringing, things that they've launched in 2021. Another Stainmaster line. This slide I really really like. So this was the old store delivery model. As you can see, it says inefficient and overly complicated. So here we have, a traditional vendor going to a bulk distribution center, and then from the bulk distribution center, it's put to the store, the stock room, storage containers. It's put on a truck and then it's given to the customer, or it's driven to a different customer site. And it's very time consuming, this sales process. People coming in, having to talk to people, book this sales, and then it just becomes a whole whack of different things that could go wrong. So now they're transitioning to what's called a market delivery model, and they're saying it'll be fully rolled out in 2023. So it's a vendor going to the bulk distribution center, but no store. It's no stores, no confusion here. It's just a cross dock terminal. So the truck will come pick it up and then deliver it directly to the customer. And this is gonna drive their operating margin, their incremental sales. Those will be improved. Inventory turnover, they'll be able to track their inventory a lot better, as it's not being put through this whole entire process, and they'll be able to give a better customer experience. Here a person, for instance, they have the option of going to the store, and ordering it there, but they can do it online, and this is just so much more efficient and will give them a lot more cost savings and increase their margin over time. I think that's an awesome model to move towards. So here they give a little bit more background on how this is going to look in the app, and things you can do, and visualizing this is super super great. It's incorporating technology with a home renovation business, which a lot of people might not think, oh, Lowe's is a tech business, but as they expand, you need technology. You need to take advantage of technology in order to grow your business, and I love how they're doing this. So here's some brand reputation they have. Number one specialty realtor, 22 overall in 2021. Just keep going. Again, focus on their total home strategy that we just saw, kind of hitting that home. So you see what their CFO says. So they want to drive core operational excellence, significant cash flow generation, and optimized capital deployment. So rewarding shareholders, enhanced shareholder returns. So we'll get into the financials a little later, but here's just a snapshot. This is the sales per square foot in their warehouses. They've gone up 36% over these, past 3-4 years. Their margins are slowly increasing, taking advantage of that technology and efficiencies where they can. And their return on invested capital, this is the return that they get on the money they invest in the company, that's also going up at a high rate as well. That's going up, at the highest rate, besides sales. So they've returned over 30 billion to shareholders. This is from 2021. They've returned even more now. Last quarter they increased their dividend by I think like 25 or 33%. So super very shareholder friendly company. Keep their shareholder in mind at all times. They've done 95 billion in sales. They affirmed their last year's. We'll get into 2022. They just released results in the past quarter, so we'll look at that as well. Operating margin 12%. They're up slightly. They always buy back a lot of shares, which is super great to see, and they control their capital expenditures. So like we said, they had 75% do-it-yourself consumers. That's consumers like me walking in. Well, maybe not me, maybe somebody who's better at home improvements, but somebody walking in saying they're going to build their own basement or, renovate the kitchen themselves. And then the pro mix, those are professional contractors coming in to build houses or home renovation. So they're going to try to increase this market share right here. This was the 2022 financial outlook. And then these were their operating margin drivers, pricing, higher brand penetration, and they try to control their selling, general, and administrative costs. So this was their plan to return capital over the next 3 years. Free cash flow, they're going to, increase their debt to make higher cash, and they focus on doing that by, raising that cash, putting it to a combination of increasing their business, growing their business, dividends. They want to pay out a ratio of 35%, and buying back shares, which gives us as shareholders, a higher equity percentage in the company. Again, this is just highlighting what we went over, but taking market share across DIY and pro, significant product expansion opportunities, disciplined capital allocation. That's kind of my favorite thing to see. They're being disciplined with the money that they make and how they reward us as shareholders. Okay, so now that we've seen those, and this is kind of reliant on 2021. Let's look at the 2022 results that they just released, 5 or 6 days ago. They had 23.5 billion in sales, so up about 2.4% from the same quarter last year. So not huge growth. It's not like a Google or an Apple where they're up 10, 15, 20% over year, but still respectable. They're up 3% on the U.S. comparable same-store sales. Gross margin increased, so this is something good, by 20 basis points. So, again, not significant. 1 basis point is 1/100th of a percent. So, the operating margin in the last quarter last year would have been 33.10. But still, seeing incremental increases, so they're definitely cognizant of their costs. That's very, very good to see. Operating margin and the diluted EPS, now these have gone down. This is directly in relation to the selling of their Canadian counterparts. They sold off their Lowe's and Rona stores in Canada, and this has given the effect of diluting their EPS. So that's why we want to look at the adjusted operating margin. This has, adjusted for that. So we can see that the adjusted operating margin is 12% at 54 basis points higher than the last quarter last year, and then their adjusted diluted earnings per share is actually up almost 20% over the last quarter last year. So that's really where we want to look at. And then we've seen that they've returned $4.7 billion through dividends and share repurchases. Awesome. So they're rewarding us through dividends, which are cash payments, which we can then use to buy more shares of the company. Or if you're living off of the dividend, it's not super high, but that's an option. And they also reward shareholders through buying back the stock, which gives you as an equity owner a higher percentage of the company. So here are some other sales. We can get into them quickly. One that I really like here is they sold more in their plus $500 product category than their lower product category. So they're selling higher ticket items. So they can drive margins by selling higher ticket items and getting higher sales by selling those expensive items. This is the products where they saw outperformance in building materials, electrical, hardware, kitchen and bath, lumber, millwork, paint, rough plumbing. So super super good. Those are wide product categories, and great to see growth there. Here we can see Lowe's.com sales growth, that digital expansion they were talking about, up 11%. So that's great to see. Great to see. That'll drive efficiencies and increase their operating margin, and their gross margin. So here we can see they awarded $200 million in bonuses to frontline hourly associates and announced 170 million in permanent wage increases. That's awesome to see as a company. Us as a shareholder, being a little greedy, we might want to see that as a dividend or paid out more. But in the long run, it's great to see these people getting paid, bonuses and permanent wage increases in this high inflation environment. Just as a human being, I love to see other people get paid more. And in retaining employees, if you keep your employees happy, they'll stay. So your turnover costs will be low, your hiring costs will be less. So this, could actually save money over time. So now that we've seen, their third quarter and how well they've done, let's hear from their CEO and see what he thinks.
It looked like every metric that I could find, you all did better than the street was anticipating. Do you see any weakness when it comes to the consumer right now?
Home improvement is a little unique, and the demand drivers for home improvement are distinctly different than the demand drivers for, let's say, home building. So when I look at Lowe's, the three highest correlating factors to demand are home price appreciation, and the average U.S. home has roughly $330,000 in equity. The age of housing stock is another one, and the average U.S. home is roughly 40 years old, the oldest since World War II, and also personal disposable income. And although economic times are challenging, we still have roughly $1.2 trillion in excess savings versus pre-pandemic. So when you look at all those factors, those things bode well for home improvement, and we feel really good about our current trends.
You had strength coming from contractors and professional builders and from the do-it-yourself crowd. Do-it-yourself, I think, is about 75% of your revenue, so that obviously matters, and that's where people have had questions. Would the consumer hang in there? You didn't see any slowness towards the end of the quarter. I'm asking this just because Home Depot, when they talked about this yesterday, they were talking about how they were getting some mixed signals. It doesn't seem like you are.
Well, Beck, what I can tell you is that for the entire year, we really had strength in the pro segment of our consumer base, but in the third quarter, we actually saw the do-it-yourself customers start to come back. So we had actually the best DIY performance of the year in the third quarter. Now, when you look at the specific categories throughout what we sell, there is a little bit of a mixed bag, but overall, we see customers trading up. So you always hear the phenomenon that people are trading down. That's not happening in our space. We introduced a Maytag washer specifically to deal with pet hair. It's one of the most expensive washers we sell, and the response to it was incredibly positive. So we're seeing customers trade up for innovation. We're seeing customers trade up for discretionary items. Our Halloween sell-through was really strong, and there's nothing more discretionary that you can buy for your home than Halloween. And our current Christmas trimming tree trends, are reflective of pre-pandemic trends, which is exactly what we anticipated. So we're not seeing a slowdown. We're not seeing customers trade down. We're not seeing customers pull back. And I just think that the definition or the redefinition of the home is something that we're still living with coming out of the pandemic. I don't think any of us can view our homes the same way as we did 3 years ago. And I think the home improvement sector is just a benefactor of those trend shifts.
Marvin, let's not gloss over that if there's a lot of pet hair on clothing, it gets it out or something. I watched someone try to clean a jacket yesterday with using tape around, and trying it, and that didn't work. And we can't find a vacuum cleaner strong enough to pick up the hair from 2 German Shepherds, Marvin. So but that's not what I want to ask you, but let's not gloss over that. What I did want to ask you, So housing prices go up, people feel good about their house, they got equity to do improvements. Housing prices go down, they don't think about selling, so they stay home and do an improvement. Which is more powerful a factor for you and Home Depot? When people are stuck in their houses because the housing market's weak, or people are able to sell their houses and move somewhere else? I just can't, I think it'd be good for you to do well in both scenarios.
Well, that's true. So if you go back to the 1990s, it's really the last time we had a situation where interest rates were going up, and we had some degree of inflation. And what we saw is home improvement demand stay strong. So let me give you a couple of factors. So we still, in the U.S., have roughly 1.5 to 2 million homes under current demand, which means we still have a shortage. And roughly 90% of homeowners have either a low fixed mortgage rate or they own their home outright. So the action being taken by Chairman Powell and the Fed is not really impacting homeowners with a fixed rate or who own their home. So the interest rate environment is not directly impacting how they feel about their most important asset. And also our data tells us that through 2025, we're going to see 250,000 millennial buyers per year enter the market. And I remember back a few years ago, many people thought that millennials would move away from owning and be permanent renters, and that's just been the opposite. Some of our strongest home improvement and home buying trends are coming from millennial customers. So all of the things work for us, but the fact that homes are getting older, and when homes get older, there are things you have to get fixed. And 2/3 of what we sell is non-discretionary. If your roof is leaking or you have an appliance that breaks down, you can't choose to ignore it. So that also supports our business trends.
More than ever, we need to indulge a little to savor the taste.
Sorry about that commercial. So, going back to that, I love Marvin Ellison. He's a great CEO, and just an awesome interview. So like he said, there's a lot of great points for Lowe's. They beat on every financial metric like revenue, earnings per share, and he pointed to having a strong consumer. So a lot of their consumers, like he said, they were surprised that they were millennials. A lot of people thought that millennials would be shifting away from buying homes, but kind of the opposite has happened. And the average age of homes is getting bigger. People are holding their homes for longer. Like he said, it was, I think, 40 years. So when you have a house for 40 years, you have to continually renovate it and upkeep it. So they're seeing a lot of strong demand. And like he said, 2/3 of their products are non-discretionary. If your roof leaks, you have to fix it. If your, basement floods or something happens, you have to fix it. Your shingles need replacing, all of that stuff. So it's great to see that they're focused on those items and that they're able to drive growth, and people still have a lot of equity in their homes with this whole price appreciation over the pandemic, and they have a bunch of capital tied up, so they can spend money on their homes. And especially those people, like you said, that have fixed rate mortgages for 4 or 5 years still, they're not really worried about the interest rates. They can go and do a home renovation right now if they have the equity and not really worry about it. So I see Lowe's as an awesome company, well positioned for growth. Now that is, a very big overview that we've done. Now let's go and look at like the financials of the company. So here we can see Lowe's trades under the ticker symbol LOW, trades at a current share price of $210.27. I have this in my portfolio. The market cap is around 128, almost $129 billion. Trades at a price to earnings, so that's the price per the company divided by the earnings per share at about 16. We can see it gives a free cash flow yield about 5.6%, very good. The margin, is small, is very small. This quarterly earnings, again, we have to kind of a little, ignore year over year because of the Canada portion there. And we can see their dividend yield. Now it's at about 2%, so respectable, nothing huge, but not small enough to ignore. And they are a debt company, so we'll dive into that a little bit later. But the payout ratio is about 29%. They said in their presentation they want to get about to 35%. So they're going to keep growing their dividend. As we can see, the price year to date, it's down 18%. It was down a lot lower, I think about 30-ish%, down around here. So they have gone down this year. But that's just the stock price. So let's go and look at their revenue. So here we can see their revenue is growing. Like they're a monster. So they grow revenue, quarter after quarter, year after year, at about 6.7, almost 7% per quarter. And as we can see, it's cyclical, right? Like it goes up and then it goes down for a quarter. Up for a quarter, 2 quarters, down for a quarter. So the reason for this is, if you look at when those happen, the up quarters are usually, in spring or summer, as people, are able to go and work on their home renovations and improvements. It's nice outside. But then in late fall and winter, that's when people, go head inside and they're not really working on their homes as much. They're just trying to stay warm. So there's a lot of seasonality in here, but the growth trend is increasing over time in revenue. If we look at their EBITDA, this is where they really shine. Their EBITDA is just a fancy way of saying earnings before any interest, tax, depreciation, or amortization. So their EBITDA is growing at a high rate of 11%. So they're able to control their costs here while generating revenue. Great to see. Okay, now let's go and look at how they, reward shareholders. So like we said before, they had take on large amounts of debt. Debt is here in the red, cash is here in the green. This peach color is capital leases. These are kind of accounting classifications for the rent that they have to pay on their warehouses and office buildings. So I don't actually look at it as debt. It's just, rent payments. So let's ignore that. So cash, we can see, they operate, like I said, in a high debt position. But the reason for that is, how they reward shareholders. So if we look at it, they decrease their look at how fast they're buying back their shares. They take that debt and that cash, that debt they get financed at a lower interest rate, presumably, than rewarding shareholders, and they buy back the shares. So they're buying them back at an almost 6% per year over the past 10 years rate. So this gives you a larger equity share of the company per year of almost 6%. So they're rewarding you by taking on debt, but then buying back the shares. And then, in the future, when they don't need to take on debt, they'll have all this extra free cash flow, hopefully, if everything continues to go as it is, that they can then maybe divvy out to you as a dividend. And I bought this purely as a dividend play and a dividend growth play. And as you can see, they grow their dividend at huge amounts. So over the past 10 years, they've grown it at a rate of 20% per year over the past 10 years. So this is just incredible. Like this, they just announced a dividend increase, and I believe it was 33%. So they grow their dividend, and I love this because now I'm able to buy back I'm able to buy more shares of the company, reinvest the dividends, and see, how they can grow and pay me more dividends in the future. Okay, now let's talk about valuation. We looked at these. Like we said, they're trading at 16 price to earnings. They're not very expensive. I guess you could go maybe to 15 price to earnings, but at forward earnings, being at 14, it's not a huge multiple, and they offer a free cash flow yield of almost 6%. So, like I said before, they pay a healthy growing dividend. I think that at a current price today, it's a very good, possibly value play and something to add to your portfolio, especially considering they're trading around $260 here before. So, now that we've talked about Lowe's and we've seen their financials and their, overview, they're still, open to risks. Like I said in the beginning of the video, they're a duopoly. Their number one competitor is Home Depot. So naturally, there's going to be competition. And Home Depot, their revenue mix is more geared towards professional contractors. They're made up of 50% professional contractors and 50% retail consumers, while Lowe's is currently 75%, retail consumers and 75% or 25% contractors. So what I can see happening over the future is, as they try to penetrate into this pro market, they could hopefully, maybe get to a 50-50 where it's, do-it-yourself consumers and pros. So they have a chance to take some market share away from Home Depot if they can get into that market segment and treat their customers, their pro customers, with respect and build those relationships. So in summary, I think Lowe's is an awesome company. I think it's a fantastic dividend growth stock, and I'd love to continue to add it to my portfolio at current prices. Lowe's trades, at a forward earnings of like 15, which we just saw, and they continue to grow their revenue, their EBITDA, and have growth in their net income at high rates while growing and maintaining a sustainable growing dividend. So I plan to continue to dollar cost average into this company, and with the goal of building my portfolio over time, building a dividend stream, and hopefully just let it compound over a long term. So thank you for watching. I hope you enjoyed it, and I hope you have a great day. Please note, this is only my opinion, and make sure you do your own due diligence when investing. Thank you again.